Hello, everyone. Welcome to PwC Tax Bite Podcast. My name is Peter, and I'm very happy that I have a full room here, a full virtual recording studio with speakers of our international tax webinar of earlier this week. In this episode, I would like to speak with the speakers of our webinar, just to understand a little bit what were the key topics of the webinar, what were the key messages, and what are the learning points. First of all, let me introduce our speakers for today. First of all, we have Jean-Philippe van West. Jean-Philippe is well known for the audience of this podcast. He's a senior counsel in our team and part of his time also working at the Vrije Universiteit Brussels. Next to that, we have Gilles. Gilles is an expert in many things, amongst others global mobility and the tax aspects of global mobility, and that was also the topic that he covered in the webinar. We have Yoni with us today. Yoni, well known again for the audience of this podcast. She's an expert in Pillar 2, amongst others, and she will talk about Pillar 2 in this podcast. And we have Helena. Helena is part of our international trade team. So she's an expert in international trade and sustainable trade. And that also is a topic that she covered during the webinar. So welcome speakers to this podcast. We will talk about what you have explained to the audience in the podcast and in the webinar. But first, Jean-Philippe, I wonder, in September, we already had a podcast on your international tax webinar at that moment in time. Why was there a need for another webinar?
Thank you, Peter, for the question, and hello, everyone. Thanks for dialing, for tuning in. Since September, there have been many developments, and really at an incredibly fast pace. So even that fast that initially we had, or like that much that initially we planned a 1 hour and a half session, that we had to prolong that to a 2 hour and a half webinar to give sufficient attention to all the different developments. So first you had indeed the side-by-side system, the side-by-side package that was released 5th of September. We had many developments on trade and tariffs. So since September, you had newspapers, suddenly new tariffs introduced, an agreement, a new trade agreement concluded by the EU, then suddenly, objections raised by the parliament and so on. So as well, many developments in the trade and tariffs landscape. And as well, we had in November an update to the 2017 OECD model convention. So 8 years later, now 2025, so 8 years later in 2017, finally an update to the commentary on the model convention, mainly focusing on home office as a permanent establishment there. So that were 3 blocks, but then in addition, you have several other developments. On the EU tax agenda, you have the UN Framework Tax Convention they're working on. Smaller or maybe developments that receive less attention, but for example, just earlier this week, the OECD released its manual on effective mutual agreement procedures, the MEMAP. You have as well public CBCR, so many developments, and therefore we thought it was highly needed to organize another webinar.
Yes, clearly, Jean-Philippe, a lot of things to talk about. The world is continuously changing, so it was time indeed for another webinar. One of the key topics during the webinar was, the side-by-side package, Pillar 2. So maybe, Yoni, we don't have time to go through all the details, of course, of the webinar, but maybe for the audience, can you explain what exactly the side-by-side package is and why you found it important to talk about it in the webinar?
Yes, absolutely, Peter. I think indeed it was definitely a key topic during the webinar. And the side-by-side package is actually a new piece of administrative guidance that will eventually be incorporated in the consolidated commentary of the OECD. And the document has approximately 90 pages and covers 3 big blocks of guidance. So a number of simplifications that were, that we were waiting for by the OECD. Then the introduction of a substance-based tax incentive, safe harbor, and then as well the side-by-side system. So why is this now such an important development for Pillar 2? Like, on the one hand, it summarizes the outcome and the practical implementation of the G7 agreement that was reached in July, so earlier on. And this introduced amongst others, a side-by-side safe harbor that exempts US headquartered multinational groups from the application of the income inclusion rule and the undertax profit rule. But on the other hand, as I mentioned, it introduces a number of additional safe harbors with respect to the Pillar 2 calculations. So the first one is the extension of the transitional CBCR safe harbor. The second one is the introduction of the simplified ETR safe harbor. So this would be an additional permanent safe harbor. And the third one relates to qualified tax incentives or the substance-based tax incentives safe harbor. And during one of the previous episodes of the podcast series, we also discussed the package in a bit more detail. So if anyone within the audience would like to know a bit more, then maybe it's a good idea to look for that episode last month.
Yep, thanks, Joni. Indeed, the episode is still available, so people are welcome to listen to it. Yeah, all these safe harbors, I think it must be quite overwhelming almost for the audience and for the company subject to Pillar 2, all these safe harbors. If you look at the entire package, Joni, what would be the most practical takeaways that you would give for businesses and the audience here?
Yeah, indeed, as you mentioned, right, really, it's like a lot of new safe harbors. So I think there it's important for businesses to look at what are now the safe harbors that would be available for the multinational group, and then in the next step, opt which ones can be beneficial and which ones to apply. With the note, of course, that a lot of jurisdictions are now taking action to implement the package. So it will also be important to monitor which ones are available in which jurisdiction. And I think the most important takeaway, maybe going towards the 30 June deadline for a lot of multinational groups, is that this side-by-side package does not have any impact on the compliance requirements for 24 and 25. So it means that this Belgian QDMTT return, for example, but also a lot of globe information returns, globe information return notifications, other types of Pillar 2 returns will be due in the coming months. So I think it's important to prepare for that one as well.
Thanks. Yeah, some clear takeaways for the audience. I, of course, was presenting with you on Pillar 2 and often work on the topic. So I also had a few reflections of my own that I wanted to share with the audience, if that's okay. Well, for me, one of the most interesting things that we will see in the coming months is, as you say, only the implementation. Now, in the package, there are various options in respect of timing. Yeah? So countries can decide to implement the permanent safe harbor a year sooner or a year later. So there are some optionalities, and you will see, I think, a kind of a scattered implementation where it will not be that clear for companies which countries have already implemented a safe harbor or not. So I think this will be a very important task to keep track in the different countries of which safe harbor is available to use in a certain country. So that's going to be a big challenge, I think. Another thing that I took from your examples, very interesting examples that you gave in the webinar, is that by implementing in a smart way the different safe harbors, for instance, the tax incentive safe harbor, you can have a big difference in the ETR for Pillar 2. So making smart choices there and invoking the right available safe harbors will be important. So definitely a takeaway for me, for the audience. And we cannot say it enough. One key milestone is going to be the compliance, which is due by June 30th this year. A lot of QDMTT returns have deadline June 30th, at least for companies who follow calendar year. That's an important comment, of course. And the global information return. So this key deadline, 30 June, will come quickly and will have a big burden of all the deadlines coming together. So be prepared, I would say, to the audience as a takeaway. Now, moving on to Gilles, another topic, and the topic you discussed in the webinar is the mobility of work. This is clearly a hot topic. I think in every single discussion I have with a company, it comes up in one way or another. So clearly it merited a different section in the webinar. What should the listeners that were not able to follow the webinar know about the topic, Gilles?
Yeah, thanks, Peter, and hello, everyone. So, well, maybe just to take a step back on mobility of work, ultimately, there's two components to that. First component is sort of the work from anywhere, which means, working from a place where the company doesn't, have taxable presence outside the country of employment. The second component is, well, I call it more hire from anywhere, which is hiring, say, senior executives from a location outside the sort of headquarters or the location of the IP ownership. Both of these are coming up, as you mentioned, quite frequently in discussions with companies, and is really becoming an issue. The topic that we talked about in the webinar was mostly focused on the former, so the work from anywhere dimension, and specifically the working from home component. The reason for that is because the OECD at the end of last year, released updated guidance around the permanent establishment definitions in the OECD Model Tax Commentary. And essentially what was introduced in that updated commentary was a 2-tier test to determine whether a home office or another type of location, say a holiday house or an Airbnb, etc., whether that home office constitutes a permanent establishment. And the 2-tier test that was introduced was essentially looking at, does the individual spend more than 50% of his or her time in that location of the home office? That's test number 1. Test number 2 is there a commercial reason for that person to be in that location? Where this last one is a new test. So the OECD also introduced quite some examples there. For example, having regular contact with clients, having a beneficial time zone. So really, is there a good reason, a beneficial reason for being in that location? Is sort of that second component of the test. In addition to that, 2-tier test, which was being introduced, of course, other permanent establishment conditions still remain, such as preparatory and auxiliary testing, as well as the dependent agent permanent establishment test. The new guidance was mostly focused on the fixed place of business in relation to the home office. So it was ultimately a helpful evolution to have this new guidance, which lowers the threshold essentially, as from which point a home office will trigger a PE in most instances. So that's why we found it helpful to cover it during the webinar, as this is an important evolution. The hope, expectation is that there's going to be further work as well on this topic around global mobility as part of the recently launched OECD initiatives. And the hope again is that the guidance around both permanent establishment, but also the transfer pricing aspects of dispersed senior decision makers and how to remunerate those, it will be tackled as part of that, those new projects by the OECD.
Thanks, Jill. So I imagine a lot of people in the audience will think, hey, this is pretty relevant for my situation. There could be an impact maybe of this new development. What would be your recommendation for those in the audience that think, hey, we need to take action here?
Well, the 2 points of recommendation, which we also covered in the webinar, is one, to relook or revisit your work from anywhere policies, because the new home office guidance may have a beneficial impact on those. So I think that's an important one to cover. And then the second one is to make sure that over the coming months, as the OECD continues to work around this topic, to continue monitoring the guidance, and especially, I would say, in relation to the location of senior decision makers and the remuneration for those senior decision makers, as we anticipate some additional transfer pricing to come out by the summer, which we expect will also deal with this topic. So quite some important months to monitor as well from a policy side. Yeah.
Thank you, Joe, for that helpful guidance for the audience. maybe it's time to shift to another topic again. And Helena, I'm going to ask your input here, of course, because it's about trade. Yeah, the trade agenda is very clear. We have seen trade deals. We have seen new tariffs in the headlines of newspapers all the time. Can you maybe for the audience give a brief update on the current status?
Yeah, indeed. We see a lot of movement on the trade front recently, both in the US and the EU. So maybe let's start with the US. So we continue to see tariffs that they are being used as a geopolitical and also an industrial policy tool. So over the past months, the US, they have signed and updated a series of agreements with several trade blocs. But at the same time, the US-China dynamic remains fragile. The US is also still keeping a long list of products under tariff pressure, particularly in areas seen as more strategically sensitive. Think about the semiconductors or the critical minerals, but also some manufactured goods. And this isn't slowing down. So in 26, tariffs, we see they remain the preferred tool of the US for pressuring their trade partners. Also think of the Greenland saga there. And we don't expect this to go down anytime soon. Besides those aspects, we also have the ongoing Section 232 investigations, which will also lead to new tariffs, likely on sectors like the pharma industry, robotics, wind turbines, but also copper. And another item to look out for will be the outcome of the Supreme Court proceedings on the IEEPA tariffs. So whether they are deemed lawful or not. If not, be ready to react to rectify your import declarations. So overall, still high activity, high uncertainty, and very sector-specific exposure, I would say. Now, when we switch to the EU, the EU trade agenda, you can say, has two pillars right now. First one, protecting the single market, and the other one, looking into extending that global trade network, both as a reaction to that volatile relation that we see with the US these days. On the defensive side, the EU is tightening the import controls, for example, through packages like the steel overcapacity package, where they are targeting and looking to cut the quota on steel and also to double the tariff from 25 to 50% when your shipment falls out of the quota. We also have the sanction packages against Russia, which are piling up. And then maybe a bit particular, but starting the 1st of July, we have this new €3 flat custom duty that will apply to all the low value e-commerce parcels. It's a small but symbolical important step in ring-fencing that European market. More on the offensive side, the EU is progressing several major free trade agreements. The deal with Indonesia is essentially ready, expected to enter into force in January 27 already. Talks with India continue. We have a political agreement in place there. And this one is very symbolic as well. This would make us one of the biggest trade blocs of the world. The negotiations with Mercosur, they were finalized in January 26. Ratification is delayed there because the European Parliament is still seeking a legal opinion on this. But to summarize, both the US, the EU, extremely active on trades. The US is leaning into tariffs as more of a strategic lever, and the EU is balancing more that defensive measure with push to expand the network of free trade partners. So yeah, still interesting times ahead, I would say, for companies.
Yeah, thanks, Helena, for that concise summary of the current status. Indeed, yeah, many developments ongoing and ahead of us. Was there also developments around the more sustainable trade agenda?
Yeah, indeed. I think two important developments to mention there. So you have the EU deforestation regulation and the policy development. So it is again postponed late last year. This time Also, simplifications were published, and the European Commission took into account the feedback of the sectors who are impacted. And in April of this year, we expect that the Commission will publish potentially even more simplifications. So more on that later. What is clear when you look at those measures is that the reporting and the compliance will now be fully shifted to the importer, so the company that is bringing those EUDR commodities, as we call them, being cattle, cocoa, coffee, palm oil, rubber, soya, and wood. The companies that bring those commodities over the European borders, those will be the mostly impacted. Maybe next also an update on CBAM, the second important topic, the Carbon Border Adjustment Mechanism. This year, CBAM has officially entered into the financial phase, which means that companies importing those goods in the EU now need to operate as an authorized CBAM declarant. It's a status that you need to get. They are also required to submit annual reports instead of the quarterly reports. And crucially, as of February 27, they will need to surrender CBAM certificates that reflect those embedded emissions of the imported CBAM products. Now, why is this already important? Because it sounds like this is still far away, but also for the products that are imported right now, today, since January, for those products, you will need to surrender CBAM certificates. So with this shift comes a higher cost exposure. As CBAM, it is real now. And everything depends on the quality, the availability of your supplier and your installation emissions data. So if you want to avoid using the default values and the benchmarks published by the Commission, they reflect the worst in class installations. It is important that you reach out to your suppliers' installations to have that actual emission data available. Looking forward, we also have a major expansion of CBAM on the horizon. So a new proposal would significantly widen the product scope. This is expected by 2028. So beyond the initial high emission sectors like steel and aluminium, we're now looking into 100 additional steel intensive products, which include pipes, cables, finished metal goods, but also machinery parts. Even household appliances will be in that scope, and car parts. So CBAM is moving deeper into the downstream and the consumer-facing sectors. It is expected that 7,500 additional importers will become subject to CBAM. So I think another message of the European Commission that this measure, the Carbon Border Adjustment Mechanism, it is here to stay, and they take it very seriously as one of those mechanisms to ring fence and protect our European markets. Maybe a little thing on what this means for companies. So the CBAM costs, they will continue to be driven by import volumes, the embedded emissions, and the certificate prices that are linked to the EU ETS. So keep in mind, there are ways to mitigate that exposure. Most importantly, working together with your suppliers to secure the actual data, as I said before. But you can also look into revising your trade flows. We see a lot of companies improving also their customs processes, looking into their procurement strategies, tightening contract clauses, and many more, where there is an important carbon cost. We also see companies looking into options like potentially hedging that cost to stay ahead. I think that concludes the update on CBAM. Thank you.
Yeah, thanks, Helena, for that update. Yeah, so clearly a lot, again, developments. This was a very big part of the webinar as well, the trade agenda. So, Jean-Philippe, as we reach to the end of the podcast, maybe back to you. The webinar was about the developments in the past months, but I'm going to give you a little challenge here now, of course. If you take your glass ball, do you see the pace of developments continuing, slowing down? And do you have any insights in what we should expect in the coming months?
Thank you, Peter. Not an easy question, but of course I will try to do my best and look into my my crystal ball. My expectation is that there will be much more to come in the next months, the continuation of this year. I would like to, there are many things that are happening, but I will try to focus on four things. The first one is the EU decluttering agenda. So to make the EU more competitive, they're looking into the European tax directives communicated by the European Commission. And there they say, well, in June we can expect on the one hand a tax omnibus, where they look in several tax directives, parent subsidiary directives, interest royalty directive, the ATAT1, ATAT2, and so on, to revise that one, streamline it. But that as well look into an update of the DAC directive, DAC 129. So that is, they said in June, so looking forward to that one. Second thing to look forward to is so now they delivered the side-by-side package on the 5th of January. But as you mentioned, as Joni mentioned, the implementation thereof in the weeks, months to come, there so further simplification, additional guidance, changes to the global information return, domestic implementation. So there as well, lots of developments ongoing, which we will then see appearing hopefully in the months to come. And a third block is that, well, the last years, the OECD has been very busy with Pillar 2. Now that they delivered this side-by-side package, there will shift gears as well a bit and focus as well on other work, such as tax aspects of global mobility. Yes, as Gilles mentioned, they communicate as well to resume the work on Pillar 1, so not in a different form probably, but start again the conversation of how to tax the digital or digitalized economy. So that's the shift to other priorities of the OECD. That's a third one to look forward to. And a fourth one related to that one are the developments at of the UN Framework Convention on International Tax Cooperation, where as we speak, the negotiations are ongoing. And in particular, the interaction between the work at the UN and the work of the OECD. So one of the work streams they're working on, one of the early protocol is taxation of cross-border services, and they just released about a week ago a document where taxation of cross-border service, where they mention, for example, the work on Pillar 1, where they say that where developed countries prefer net taxation, use the PE threshold. Developing countries are more in favor of gross taxation, look for alternatives. So you see that there's a clear some overlap between the two, and it will be interesting to see the interaction between the developments at the UN and what the OECD will be doing the next month, and see whether there's really an interaction or really interference of the work of these two organizations. So that's as well something I'm look forward to see how that develops. But so to wrap up, so clearly enough food for another webinar, let's say by the end of spring, start of summer.
Yes, Jean-Philippe, I imagine by that time we will have a lot to talk about. Yeah, a lot of people attended the webinar, obviously, but I guess some people in the audience might say, hey, I would like to still see the webinar and get the contents. If you registered for the webinar, you normally will get a link to the recording. If you listen to this podcast and you were not registered for the webinar, I suggest maybe Jean-Philippe, they reach out to you to get in contact and still obtain access to the recording of the webinar. With that, I would like to thank the audience for tuning in, but of course also my speakers. So Helena, Joni, Gilles, Jean-Philippe, thank you very much for being here in the recording studio, and I'm sure we'll be in contact soon for further updates. Thank you.